Okay, so we have a couple things to cover today that I want to go through. First, I want to do just a quick snapshot of the remaining 3 weeks of the semester. Hard to believe it's just 3 weeks, but there's a few things I just want to make sure that everyone is aware of in terms of dates and assignments and those sorts of things. Then what I'm going to do is just a wrap up of some elements of Chapter 9. I want to talk through a couple of the problems to review those. I'm well aware that those problems, that chapter, that content is challenging. It's not something that on first pass I would expect to have sort of a level of excellence in your understanding. But we're going to review a few more of those problems. And there's probably going to be one problem like that on the exam. So getting some of the fundamentals down will be great. Then I'm going to just review a couple things in Chapter 12 to focus your attention on a couple of the key concepts. And then with the last half hour or so, I'm going to introduce one of the topics from Chapter 13. There's two main topics that we're going to address in that chapter. One of them we'll do today, weighted average cost of capital. The second one we'll talk about on Wednesday, which is the ultimate culmination of our class, which is how to value a business. Okay, so that's going to be our focus. So, a few things for the rest of the semester. So this is our last week of content. We're going to review, as I said, Chapter 9 and 12, introduce the key concepts from Chapter 13. Your assignments. There are 3 things that we're going to be doing this week. I have 2 short quizzes. Short, like really short. One of them tonight. It has 4 questions in it. I'm giving you an hour and a half to work on it. It's in Moodle. If any of you individually have an issue that you cannot complete the quiz by 11 o'clock tonight, you need to email me and we'll work out a way to extend it. It literally should not take you more than 20 minutes. That's my aim anyway. So if it's taking you longer than that, that's probably a sign of stop and ask a couple questions. If you're taking longer than that, you can always email me and I can offer either some explanations or a little bit of additional time, but it's designed to only take about 20 minutes, even though you have an hour and a half. I will do the same thing on Wednesday. Okay, so these are short problems that are very focused. Actually, I think the one for tonight is 2 short problems and 2 kind of conceptual multiple choice. Okay, so I'm doing them out of class in lieu of taking some of our class time to do that. All right. Then on Saturday, we'll have a couple of problems due from Chapter 12 and 13. I think there's 4 or 5 problems that will allow me to ideally grade them before class on Monday. Okay, so homework, couple short quizzes. Then for next week, we're going to take our 3rd exam. So a couple of things to be aware of there. Number 1, on Monday, I have set up an additional, I'm calling it a quiz. It's actually an extra credit quiz. In fact, it's the sample exam. So generally, I always present the sample exams for you guys that we go through in class for our review. But for those of you that wish to submit it as an extra credit assignment, you can turn it in through Moodle. So you would work on it anyway. Now you just get an opportunity to do that. So that would be due Monday before class. And then on Monday in class, we'll review that sample test. Any questions from the chapters 8 through 9 and 12 through 13. I'll be doing a review session on Monday evening. I may be here Tuesday afternoon for some individual questions. I'll let you guys know if that's the case. And then on Wednesday and Friday, we'll have our exam. So it'll be done in 2 pieces. Very likely, I will give you an Excel template that has kind of the Chapter 9 structure in it, because typically, with only an hour to work on in class, those problems, it's very difficult to get that structure developed and do the exam in an hour. Okay, so I will have that posted in Moodle so that you guys can have that as a reference. Okay? So that will be next week, finishing up the exam. Then, the final week, we're going to be delivering your presentations that you all have been working on all semester. On Wednesday, I will be drawing team numbers out of a hat randomly, first picking the Monday groups, then picking the Friday groups. If any of you wish to move to one of the days, I'm happy to have you swap. Just let me know. But that way I can do kind of a random check, and then if you want to go earlier or later, you guys can work that out amongst the groups. Group A will be in our class on Monday. Group B will then be Friday, that should say 10:30, which is our exam period. Okay, and we will unlikely be in this room. I will probably, if I can get a room in the Johnson Center that's a little bit bigger, a little more spready outy, we will do that. And then the final thing for the presentations, I typically have guests come who help evaluate you guys and also ask some questions. So I will let you know next week at some point who those guests are. But generally they're other faculty and interested parties from around campus that I think will enjoy hearing what you guys have been able to put together over the course of the semester. Okay? So plan for that. Any questions about that? Oh, the one thing I didn't mention, your final kind of interim assignment for the presentation is to actually do what I call a kind of pre-run or practice run. So you'd be planning to get together with your team, do a walkthrough of your presentation, make sure that everybody has their part, make sure that you can deliver it in 15 minutes. And you should, pull up one of your laptops and video record your team doing that practice. And that's the submission, is just me seeing your team do that practice. Generally what I recommend is you guys upload that video to YouTube or video or Vimeo or whatever it is, and then submit the link in Moodle, because you can't upload a video into Moodle. Moodle doesn't allow it. Your videos are too big. So upload it someplace else and then just submit the link. That's usually the best way to do it. If you have any questions about that, you can let me know. The final thing I will say is I think I have everything graded except for one of your last library research assignment. I've graded your outlines. Please review the comments that I made on your outlines. Some of the teams I suggested strongly that you re-review your outline and submit it again, because there were certain gaps in it that I found to be important enough that I'm asking you to resubmit it. So please do that this week. And some of you want to pay particular attention to your grades to this point because you're on the bubble. And the third exam is generally a big determinant on how you sit relative to that bubble. If you have any questions, you can ask me, because I have everybody's grades up to date. And they look a little different than what they're in Moodle. Moodle, I keep a separate spreadsheet. Moodle handles the attendance grades in kind of a weird way. It also handles some extra credit things in kind of a weird way. So you guys should look at your own grades, make sure that there's no missing assignments that I have missed erroneously. If I have, you can email me and I can take a look at it. And also, if you feel like you're sitting on a bubble, you can let me know that, and we can, maybe brainstorm some strategies. The final thing, and then I'll get into the chapter. Before you guys leave, I have your one-page notes from the last exam, and I'm happy to hand those back to you guys, because those may be beneficial as you're preparing for the third exam. Our discussion of the finance toolkit. We are coming to the end of our journey discussing all these financial concepts. What I'm going to review today is the last little bit of kind of the cash flow analysis, the NPV evaluation, which is for projects. Okay, the one main concept for you all to keep in mind is that when we do an NPV, we're evaluating a project. When we start getting into the stuff over here on the right side of this chart, risk and portfolio analysis and CAPM, and then the stuff that we're going to talk about later today and Wednesday, we're now starting to look at the totality of the company. Right? The company has dozens upon dozens of projects and initiatives going on. Okay, so when we do this company valuation, just as a preview, we use the same discounted cash flow techniques, but we relate it to the totality of the company. So we can essentially put a price tag on the company. Okay, I want to talk about a couple of Chapter 9 problems before we jump in to clarify a few things. So if you guys have your textbook and your Excel work that you turned in for those problems, I want to go through and make a couple comments about problem 11, problem 12, and then problem 27. Okay, those are kind of the three ones that I want to focus on. Okay. So, a few things that I want to speak to and also reinforce a couple of my comments from grading your assignments. Okay. So this is question number 11 in Chapter 9. So when you guys see me make a comment that says, look at the structure or reference the template for doing the NPV calculation, this is what I'm speaking to. I'm speaking to this structure here, which is highlighted, where we have one section of our analysis that we look at fixed assets, one section of our analysis that we look at the operations of the business, and then one section that includes the working capital, and then there is a summary section that does the finishing of the calculation for net present value. So when we undertake a project, like the question in number 11, a new fad product, we're given certain pieces of information. As a process that will, I think, enable you to maybe think about this in a more structured way or a methodology, what I often recommend is using this structure and having it blank, and then you can go to the problem and figure out the financial information that's provided and where does it go in the structure. And on top of that, if, by the way, I was doing this in the context of a real business project in my job, this is how you would set it up. Anyone who has a financial background would be looking for your analysis to be set up this way. Okay, so this is not something that's just a textbook. So this problem gives us a few different pieces of information. So the one thing that it starts out by telling us is the revenue of the project. It tells us that there's 4 years, years 1 through 4, gives us the revenue for each year, and then it says after year 4 there's no revenue, it's 0. Okay, so the project is only really going to contribute to the business for 4 years. Then it's just going to dissipate. It's no longer going to have an impact. Okay, and then the other thing that we know when we're doing net present value is we're looking for the incremental benefit to the business. So by doing this new fad product, this is new revenue to the company. Then the second piece of information that the problem tells you is that expenses will be 40% of revenue. What I then do is I set up some type of analysis. If you go back up to the top of this spreadsheet, I have this section that I've highlighted here that I affectionately refer to as a sub-analysis or a mini analysis. It's an analysis within an analysis, because I like to keep everything visible. I don't like to shortcut calculations. I don't like really long formulas. So what I do is I calculate expenses. So I have a little short schedule here that says if my revenue is $40,000 in year one and my expenses are 40% of that, they're $16,000. Simple. Okay, so I do that for all 4 years, and then down below in my NPV structure, I carry those numbers below. And because they're expenses, I'm deducting them from revenue. The next element that the problem gives us is the working capital. Yeah, Helen. Yeah, for sure. Like so. Better? Okay, thanks. I need eyes in the back of my head. So the problem then tells us about working capital. Working capital is, in this year, 20% of next year's revenue. So if revenue next year is $40,000, then this year, which is now, year zero, it's 20% of that. So 20% of $40,000 is $8,000. And then next year's revenue in year two's revenue is $30,000. That means in year one, it's 20% of that. So there is a diagonal relationship between revenue and working capital. So your approach is made easier if you read the problem and you have this small analysis or subschedule, because sometimes trying to do that math in your head, it can be a little bit complicated. If you're having a hard time interpreting the question, that's something that you just kind of have to learn. And by doing multiple problems and re-reviewing the solutions, that'll help us, at least for the purposes of our class. Now what I do with this working capital is I bring it into my schedule in this orange section, which is the amount of working capital needed each year. Okay, and if working capital is a concept that doesn't quite make sense, think about it as, these are some of the immediate short-term resources that the business needs to get up and running. So if I'm making a product, before I can sell that product, I have to buy inventory, and I have to hire people, and I have to, do some marketing. So a lot of times we have to have funds or resources for the business that are needed in advance of selling things. Okay, that's the concept of working capital. So I pull those numbers down from my analysis into the orange section. Then the problem tells us that it requires an immediate investment of $45,000. That I put directly into the fixed asset section. And it's negative because we're going to buy that asset. And it's in year zero because it says it's immediate. And it's one time. So generally, the values that go into the fixed asset section are only going to be one time. They're probably either going to be in year zero and or year 4. You're not likely to have values in between. Okay, and try not to co-mingle these sections. So if you have a maintenance expense that's recurring, that would actually go in the operations section, because a maintenance expense is part of the daily operations of the business. Okay, what goes in the fixed assets is one-time stuff. Okay, so the only other thing that we have to do then to complete our analysis is calculate the amount of depreciation. So in Part B, it tells you that we're depreciating that plant and equipment over 4 years. So I take the $45,000, I apply my understanding of depreciation from financial accounting. There's no salvage value. So I take 45,000 divided by 4, and that's the amount of depreciation each year. Okay. So now I can calculate the cash flow for each of my 3 sections. Cash flow from fixed assets, I just summarize. There's nothing that I need to do. So it's negative. I'm spending $45,000 in year 0. In my operations section, the thing that you want to have in mind is that the first thing that you're doing is calculating after-tax profit. Then you're going to calculate, as a second step, operating cash flow. So revenue minus expenses minus depreciation gives me pre-tax profit. I tax the pre-tax profit at the tax rate, which is given at 40%. From pre-tax profit, I subtract tax, and that gives me profit after tax. Then, to the profit after tax, I'm going to add back the amount of depreciation. And the way that I describe it is you need to add the absolute value of the amount of depreciation. So 7650 plus 11250. Don't do it as a true sum, because the way I'm presenting the numbers, the depreciation is a negative number. So unless there's something wonky going on, operating cash flow should be a bigger number than profit after tax, because you're adding back the absolute value of depreciation. Okay? So that gives you operating cash flow. And then the last section is this working capital. So we brought down the orange line from above. And then the second line is to calculate the change. So change is this year minus last year. And the sign, positive or negative, matters. So in the change, it's this year minus last year. So in our analysis, in year 0, last year doesn't exist. So the value is 0. So 8,000 minus 0. Then in year 1, it's 6,000 minus 8,000. So it's negative 2,000. That actually means that the working capital decreased. Then we have 4,000 minus 6,000. Again, it means that the working capital decreased. And so on all the way. Now, just as a note, we don't always do working capital the exact same way. Sometimes we take it up to a fixed value, and it's that steady value until the very last year of the project. So you have to read how working capital is being estimated. So that gets you the change. And then the third step is, what is the cash flow from working capital? And the easiest way to think about that is it's the negative value of the change. So take the change and multiply it times -1. So if the change is a positive number, the cash flow should be a negative number. Because essentially what we're saying here is, I just had to go out and buy $8,000 worth of inventory. I just spent $8,000. It left my wallet. So that's a negative cash flow. Okay? And then that's the last section. Now all you're doing is math.
But,
Hey,
so I don't get how there's a cash flow from a change in working capital. If, like, in year 2 you just spent $6,000 of your working capital, you didn't get $2,000 back. You're just spending $2,000.
So there's two things about it. One is we're kind of imputing the cash flow. We're sort of estimating it. But the truth is, if I had $8,000 worth of inventory, think of the orange line as balances. Now I only have $6,000 of inventory, which means I sold stuff. I converted. What is the story of Rumpelstiltskin who spins into, into gold? Am I talking about the right nursery tale? Where he spins and it turns into gold? Okay, well this is what working capital is. Okay? Look up the children's nursery rhyme. So we had 8,000 in working capital, now we only have 6,000, so we've essentially released $2,000 of cash flow back in the business. That's the way that we think about it. Okay? It's kind of, if you remember from financial accounting when we did the statement of cash flows, we did the same thing. We looked at the changes in the current assets and the current liabilities. This is the same concept with working capital. It's a good question, though. Okay. So I think the biggest gap I saw when I was looking at the Chapter 9 problems was using this structure. I think if you use this structure and you model that, it goes a long way. Now then, you still have to interpret the problem and the data that's given to you. But in some ways, the structure is the roadmap for you. Eileen?
So for the exam, will we be given a template like this?
Yes.
Just no numbers?
Yes.
Okay.
Yes.
In Excel or in a piece of paper?
No, it'll be in Excel. It'll be just like this sheet, but it will be blank. And typically, I take the formulas out. So it has the placeholders, the narrative, and the lines, but I take the formulas out. It's just literally for you guys to do the keystrokes to type all of this. It's just, if we were doing it in a 3-hour exam in one sitting, I don't always do the template, but for our purposes, you just don't have enough time to type. That's the truth of the matter. Okay. And I'm also more interested in how you apply the values from the problem to the template. So when you guys are, doing some of your review this week, I would go back through the Chapter 9 problems. There's 4 or 5 of them, and read the problem and look at the solutions and just see how the numbers are translated over. Okay? All right, Eileen?
About how many questions will we have on the exam?
Oh, like this, only one. Only one. It's just it's too much work for...
Will that be the only thing?
I don't know. It depends on what I decide to put together next weekend. Don't worry. Don't worry. Don't worry. You will have enough questions to match the amount of time we have in class. Okay? All right. So does that give some flavoring. Let me just point out a couple of things with number 927, and then I'm going to move on. Hold on, I lost my file. Okay. So the other problem that you guys worked in the quiz, which I observed, oh no, that's the extra credit. Which I think there was progress. Like when I reviewed it, I could tell between the homework and the quiz, there was progress. So what differs with the quiz that you guys did on the Friday before Thanksgiving is that there is a sale of the asset. So if you refer back to the problem number 27, it tells you that the equipment can be depreciated over 6 years to a value of 0, but it can be sold after 6 years for $500,000. Woohoo! Right? So we go out, we buy a piece of equipment, we use it for 6 years, and then we sell it at the equipment rummage sale. Okay. In the corporate environment, when companies sell things, they have to pay taxes on gains, profits, even when it's not their core business. So much like that previous problem where I told you that there was a little subschedule, when you have a sale of an asset as part of a project, you have to have a little calculation because you need to know what the after-tax cash is for that sale. So in this case, this piece of equipment, we think that in year 6, we can sell it for $500,000. What I would do then is I would look at the book value of that piece of equipment at the time of sale. In this case, it's 0 because we fully depreciated that piece of asset. So what that means is when I sell, so the equipment is worth nothing on our accounting books, but I'm selling it for $500,000. So I, the company, have made a profit of $500,000. Woohoo! But given that I made a profit, I have to pay tax on that profit. So I pay 35% tax, which means that the cash that I put in my checking account is only $325,000. It's the equipment sale less the tax that I pay. Because Uncle Sam makes everybody write a check. So the cash flow from that sale, 1, you need to think to include it, and then 2, you need to remember to include it as the after-tax cash flow. And that's why it's 325 and not 500. Now, if when I sold this piece of equipment, it was worth $100,000, notice that my gain would only be 360. I'd have, or my cash flow would be 360. Because my gain would be less, right? And it could be that my book value, I sold it for what it was worth. Right? So now I wouldn't pay any tax on it because I have no gain. And my net gain would be 500. Aaron?
So if you have a loss on the sale, do you not pay tax as well?
When we have a loss, there's actually a tax perk, a tax credit. So when I wrote my check for my taxes, I would actually pay less taxes because I had a loss. It's a weird and wacky concept.
Can't you sometimes carry over losses?
Yes, you can.
Isn't that what Donald
Yes.
Trump did?
Correct. If you've listened to any of the political, messaging, the Trump Corporation apparently has never paid income taxes, which there's ways, because of the way the tax laws are set up, such that you have losses. You could have a $1 billion loss in 1 year, and the tax laws only allow you to take a certain, there's a ceiling on the tax credit, but then you can carry it forward to other years. It's a weird thing in corporate tax law. It's a fascinating area. When I was an undergraduate student, I did a research project on some tax reforms that were attempted in the late 80s that were a total disaster. Helene.
Something confused me about this, because
Yeah?
doesn't it say it's a 5-year project?
It says that it goes to, well, my book, it has it through year 6.
I don't have my book with me, but because I wrote it down here, and I think it said it's a 5-year project, but it's depreciated over 6, and that kind of threw me off.
Let me just read it, because my... Okay, so it says... You are correct. How do I explain how this is interpreted? Because the book, I think, could potentially have a typo in it. That's kind of what I think, because it tells you that they depreciate it for 6 years, but then they give you the sales out to year 6. So I think that the book, the way that I read it is that the book has a typo, right? But you're correct. If it only went to 5 years, you would stop it at year 5.
But then would you have the sale of the equipment? Because that was after year 6, right?
Yeah.
Yeah.
Yeah. No, that is confusing. And occasionally, by the way, I find when they reversion the textbooks, sometimes the old problem was 5 years. They make the new problem 6 years, and they don't go back and review all the details. But given what I interpreted the information, it would be 6 years. But that's a good catch. Okay, so the main point of number 27 is for you guys to see the impact of the asset sale. Okay, so don't forget that if it's in your problem. All right? Okay. Review. All right, a couple just closing comments that I want to make about chapter 12, and then we'll touch on whatever we can from chapter 13 with our remaining time. In chapter 12, there's a lot of content that we reviewed. I want you to focus on the main concepts of the CAP-M, Capital Asset Pricing Model. There's a lot of things. There's some concepts it's probably good for you to review, but in terms of the mechanics, we're focused on the CAP-M. There's a couple of important definitions and terminology and things for you guys to pay particular attention to. So, number one is, what does the calculation of the CAP-M tell you? When you do the math, what does it give you? Well, what it gives you is the expected rate of return of a stock. The expected rate of return. Why is this important? Well, there's expectations which is a forecast, and then there's actuals. So if I go out right now and I evaluate 3 or 4 stocks that I wanted to buy, I would calculate the expected rate of return. Am I going to get a 10% rate of return? Am I going to get a 5%, 20%? So before I buy that stock, I want to know what's the rate of return. Because as an investor, I want to know that. So if I'm trying to make a choice between the Disney company and Google and Ford, and I have an investment strategy, I want to know what kind of a return I'm going to get. And return in the world of stock means each year how much is that stock price going to grow. So if it's $100 today and it's an expected rate of return of 20%, it should be $120 next year. This is what we mean by expected rates of return. Now the reason that it's not the actual is because at the end of next year, now the stock has moved, the price has moved. And if it's $115, it performed below expectations. If it's $130 and I bought the stock, I'm happy because it performed above expectations. Okay, so we do this because we need to measure how stocks are going to perform. In doing this, we have the CAPM formula, which is this formula at the bottom. CAPM, Capital Asset Pricing Model. Risk-free rate plus the beta of the company times the market rate minus the risk-free rate. And when you guys are doing this in Excel, you need to set the formula up with the proper parentheses or the calculation will be wrong. Okay? So you need to do the RM minus RF, and then you need to multiply it times beta, and then you need to add the risk-free rate. You need to set that up the proper way in Excel. So each of these letters and subscripts has a meaning. So RF is the risk-free rate. It's the rate of the Treasury bill, typically. It's probably some number that's like 3 or 4%. It's the, if you put money into the bank, you're practically guaranteed that rate of return. That's why we call it risk-free. Then we have this term beta, that is the risk of the company. So the market has a level of risk, the company has a level of risk. Then we have RM, which is the market rate of return. We talked about that a little bit the week before Thanksgiving, where we can measure the S&P 500, we can measure the Dow Jones, and it's the basket of stock and the rate of return on that entire basket. And so the CAPM tells us how our company will do, but the market rate is the overall market. Then there is something that we refer, so that's RM. There is a term that is often used when we're talking about the CAPM. Market risk premium. That represents the difference between the market rate of return over the risk-free rate. So if the market return is 10% and the risk-free rate is 3%, what is the risk premium? Who can do the math? 10 is the market and 3 is the risk-free rate. 7. So sometimes we, in our Finexicon, we just talk about the risk premium. It's 7%, it's 8%, it's 10%, and all you're given is the risk premium. That is fine. Partially we do that because the risk-free rate is relatively fixed. It hasn't changed a lot in centuries. Okay. And then we take that concept of the market risk premium, and when we multiply it times beta, that gives us the risk premium for the firm. So if you think about beta, beta anchors to 1. If the company's risk is 1, it means the company is of equal risk to the market. If it's less than 1, it's less risky than the market. If it's more than 1, it's more risky. Okay? So that terminology, it's a good thing to know. Okay, and then this is the calculation. So instead of the market rate of return, and when you see R of R, that means rate of return. Instead of R of R, the market rate of return, you might just be given the market risk premium. So make sure that the term, again, this is an area where the terminology, having some of that terminology clear to you is important. Okay. In your quiz tonight, you're going to do 2 problems on the CAPM. And I think for the most part, when I reviewed the quiz, people were getting the core CAPM calculation pretty successfully. Okay? All right. So we're going to introduce now our last chapter. And I'm going to focus our conversation right now on something called the weighted average cost of capital. In some ways, we've talked about a lot of this already. So you're going to have to refer back to some of your prior knowledge. Capital is the resources that companies have to make their investments. So I want to build a new manufacturing plant. I don't have a money tree in the back lot of my offices. I need to get money. I have 2 sources, well, 3, but for our purposes 2. I have debt and I have equity. I can take out a loan from a bank, or I can issue bonds. That's debt. I can issue shares of stock. That is equity. Many companies have both of these. So, when you think of a weighted average, okay, so let's say you have I'm going to borrow from Professor Gabor. Okay, this is a grade sheet. We have 6 quizzes worth 5 points apiece, and we have 3 homework assignments worth 10 points apiece. So if I wanted to do this one way, I could add up 5, 5, 5, 5, 5, 5, right? Or I can do 6 times 10, and then, 6 times 5, and then 3 times 10. And I'll get my score. And then if I wanted to figure out my average score per assignment, I can divide by the number of assignments. Okay? Well, another way to do this is 2/3 of my assignments are at 5 and 1/3 of them is at 10. Right? How do I know that? Because there's 9 total assignments. 6 over 9 is 2/3. 3 over 9 is 1/3. This is the idea of a weighted average. It's just like if I go into the grocery store and I buy 3 bananas that cost $1 and 4 apples that cost $2. I want to know what the average per fruit price is. Okay, we call this a weighted average. And we apply this concept to the company's cost of capital, because for a variety of reasons, I need their average cost of capital, what it costs them to borrow and what it costs them to issue equity. So I do this because I need to evaluate things like a project. You guys had a discount rate or an interest rate when you did the NPV calculation. We also need this because we're looking at different rates of return, we're looking at riskiness, et cetera, et cetera. So it's a lot of the things that we've been talking about. This whole semester, you guys have been using the weighted average cost of capital. You just didn't know how it was derived. Okay, and we need the weighted average cost of capital because the CAPM is insufficient. The CAPM only gives us this piece. So we're missing the other half. If you remember, when we did bonds, you guys calculated this thing called yield to maturity. That's actually the bond's rate of return. So we need the CAPM to get us equity. We need to combine the CAPM with the rate of return on debt to get the weighted average cost of capital, because most companies use both sources of capital in some form or fashion. And then, by the way, we have two different stakeholders that care. We have debt holders and we have shareholders. So they each need to be satisfied that rates of return are going to be met. So the formula, and I'm going to show it to you mathematically, kind of looks like this. D represents the value of debt, the percent of debt. Just like this is 2/3, it's the percent of debt. The E represents the percent of equity. The V is the two of them added together, and it's the total. It's this capital. So this is D, this is E, and the capital is the V. It's a V, not a check mark. Okay? And then our debt is the rate of return on the debt. Our equity is the rate of return on equity, which comes from the CAPM. And then you have this last little piece here, 1 minus T sub C. That means 1 minus the company's tax rate, their corporate tax rate. We do this because if I have debt, and on average it has a 5% interest rate on it, all the interest on the debt is tax deductible. So even though it's 5%, the true cost of my debt is a little bit less than that. Because if interest cost me $500,000 a year, but I pay $100,000 less in taxes, really the impact is the net of the two. So there's a tax gain, there's a cash flow benefit to having tax. So what this 1 minus the tax rate does times the rate of return on the debt is it lowers the cost of the debt. Okay, how does this show up in the math? Okay, let me show you guys this chart and then I'm going to make a couple comments on it. So a company might have 3 sources of capital. They have debt, they have preferred stock, and they have common stock. Preferred stock is sort of limited, it's a little different, it's not publicly traded, it's a little bit different. Okay? This is sitting on our balance sheet valued at $9.1 million. Okay. However, because this is finance, we care about market values. So what I do is I go out to the financial markets and I look at how many shares or how many stock or how many tranches of debt are trading, and I determine that the market value of my debt and equity are these values. So, you know, I issued stock worth 2.8 million, but today, based on the trading price, it's worth 6 million. So I care about the market values. When I'm doing the percentage breakdowns, 2/3, 1/3, whatever, I care about the market value. So if you're ever given two pieces of information to solve for the weighted average cost of capital, you might be given a balance sheet, and then you might be given the market values. Don't ignore the balance sheet, but the values that we're going to use in this calculation are the market values. So what I do is I take the value of the debt and I calculate its percentage over the total. I take the value of the preferred stock, calculate its percentage over the total. Same for, so these represent, of this 12 million, what portion is debt, preferred stock, and common stock. So 50% of it is common stock. Then what I have to do is I have to go out and collect the rate of return on each one of those pieces of capital. So here's the part that makes this a little tricky. These rates of return come from three different places. The debt is the yield to maturity. The preferred stock is the dividend yield. So you take the dividend on the preferred stock, divide by its trading price or its share price. And then the common stock, this is based on the CAPM that we just talked about. So now what I do is I multiply, with one minor exception, which is when I use the debt, I calculate 1 minus the tax rate. Okay? Now, in our usual fashion, I do this in an Excel template. So in Moodle, you guys in the week 14 notes have something that says reference WACC. It's a spreadsheet. It sets up exactly how you calculate the weighted average cost of capital. It's even got some values in it. So I think that that's that problem. Right? 4, 2, 6. So on and so forth. So I want you guys to go out, look at this template, see how it works. Right? So you would collect the market values for each of the pieces of capital. You would calculate the percent of the total. Then you would collect the rate of return. Debt is the yield to maturity. Preferred stock is the dividend yield. Equity is the CAPM. And then you're essentially multiplying those two together, step 1 and step 2, with the exception of the debt. So the debt, you want to first take the cost times 1 minus the tax rate. So notice that the after-tax cost is 3.9%. So the cost of our debt is 6%. When I take into consideration the tax impact, it really only cost us 3.9%. And then I take these blue cells, step 3, after-tax cost, and in step 4, I multiply times the orange, the percent of the value. And then I add the three of them together. And so what the weighted average cost of capital tells us is with debt at 6%, preferred stock at 12%, equity at 18%, given the portfolio of capital that we have, our average cost across those three is 12.3%. So my starting point when I would do a project analysis would be 12.3% for the discount rate. And when we go to value the company, we're also potentially going to use the 12.3. So I say the starting point because this 12.3 represents the company's cost of capital at their current level of risk. So if I'm a shoe manufacturer and I want to suddenly start making drones, because the drone industry is awesome, and I find, and like maybe drones and shoes have some connection, I don't know. The drone business is not the same risk as the shoe business. So if I'm evaluating my drone project, I might need to adjust my cost of capital because it would be a different risk. All right, so we calculate the cost of capital, but it's a starting point. It's not necessarily, and that's a conceptual thing that you guys may want to make sure you understand.